Here is your weekly market outlook for crypto, gold, oil, and global shares. Starting with crypto, Bitcoin is entering next week with improving momentum. Market sentiment has strengthened as the US dollar softened and risk appetite returned, helping Bitcoin move back above the $71,000 area. From the chart, BTC is now trading around $72,954. As long as price remains above the 70 to 71,000 support zone, bulls may try to challenge 73,600 first and then the 76,000 area. A break below that support zone would likely slow the recovery. Reuters reported this week that Bitcoin benefited from the weaker dollar and broader relief across risk assets. In precious metals, gold remains firm and defensive. Reuters says gold is heading for a weekly gain, supported by dollar weakness and continued concern over whether the current Middle East truce will hold. On your chart, gold is trading around $4,763 and is holding near a key mid-range Fibonacci level. For next week, the market will watch 4,915 as the next resistance, while 4,604 is the important support. So the outlook for gold remains mildly bullish unless risk sentiment improves sharply and safe haven demand starts to fade. In oil, traders should stay alert. The latest EIA outlook says Brent could peak around $115 per barrel in the second quarter, before easing later, assuming flows through Hormuz gradually resume. That means oil may stay volatile and elevated next week, especially if geopolitical headlines intensify again. Your attached prices show WTI near $98.5 and Brent near $94.4. So energy remains a major inflation and risk driver for all markets. And finally, on shares, US equities have rallied on ceasefire optimism, but next week the focus shifts to earnings. Reuters says first quarter earnings are expected to rise about 14.4%, with tech doing most of the heavy lifting. That supports the Nasdaq in the short term, but investors will still be sensitive to oil, inflation, and any disappointment from big companies. So for next week, the tone for shares is cautiously positive, but still fragile.